Have you been considering investing in commercial real estate, but you are so confounded by all that jargon and numbers, and you don't want to look stupid? You don't want to ask the wrong questions. I totally understand how you feel, especially us doctors, right? We don't want to look stupid. So, what are these numbers and how do they matter? Okay, so I'm going to tell you the top 3 things you need to consider when you're looking at a commercial real estate syndication. But before we get started in that, let's talk a little bit about cap rate, because that's another fancy term that gets thrown around a whole lot in the commercial real estate space. What is cap rate and how does it matter? So the way to look at cap rate is that it's a measure of profitability and risk. So when there is low risk and the low initial yield from that property, cap rates are going to be low. Doesn't mean it's a bad property. It might be a great property. Sometimes these are great investments. They can be very stable and have tremendous long-term potential. The other thing that cap rate is looking at is risk. So based on the location and the market, the property condition and age, all of those things can affect the cap rate. And let's talk about how it's calculated real quick. It is the net operating income divided by the purchase price or market value. So how do you get to net operating income? You take the total revenue generated by the property, whether that's from rents or fees or whatever, and you subtract the total operating expenses and taxes. That gives you the net operating income. And then you divide that by the market value. What would people pay for this property? Or what is it being sold for? And that gives you the cap rate. But as you can see, what someone will pay for that property is going to depend a lot on the market and the condition of the property. And also, the net operating income can change a lot depending on the rents and the occupancy and vacancy, etc. So these things can change a lot. So looking at cap rate by itself is never a good idea. It's just a tool that commercial real estate investors use to compare one property against another and to get a general idea of the profitability and risk. Now, another thing that can affect cap rate that a lot of people don't consider is the interest rate. And you might wonder, how do interest rates affect cap rates? Because cap rate is calculated by the net operating income divided by the purchase price. Well, the net operating income doesn't take into account the debt or financing. So how do interest rates play a role? It's because we have these large investors like mutual funds who buy large amounts of commercial property. So they've promised their investors a certain return. Well, how are they going to get to that return when the cost of borrowing and the cost of holding that property has gone up? Well, they buy that property at a lower price. So that drives down the values of properties and thus increases the cap rate. So that's how interest rates play a part. Now, what's the next number we want to look at? We want to look at cash on cash. Cash on cash is the net cash flow of that property divided by the cash investment. So if you have a $100,000 property that you bought for $100,000 and you are earning $10,000 on that property, your cash return is 10%. So that is also reported as a percentage and it's an annual amount. The next big number is IRR. IRR is the internal rate of return. So what does that mean? The internal rate of return is kind of like the annualized rate of return, but not really. It's a number you can use to compare to annualized rate of return. So if you have like a CD or some other fixed rate of return investment and you want to see if the syndication is going to perform better than that, you can look at the IRR and the ARR and compare the two. However, IRR is very different because it's taking into account the time value of money. So the speed at which you get that return is incorporated into that number. And because of that, the IRR can be very skewed depending on the timeline of that investment. All factors being the same, that IRR can go from 10% to 30% if we just compress the timeline. And sometimes you'll see syndicators throw out deals that show a 30% IRR. And you have to look at the duration of that investment. And it's usually 18 months or 2 years. And so you're not really making that much more money. You're simply just making that money faster. That time value of money is very important to investors because that means your money isn't tied up and you get that return back and you can reinvest it in something else. So people who are looking for that will want that shorter timeline with a higher rate of return. Now, the third thing you want to look at, which I think is the most important for me because I'm looking for long-term growth, and that is the equity multiple. So the equity multiple is your total equity multiple. So the equity multiple is a multiple of your total investment, meaning how much does your investment multiply over the timeline of that investment. So if you put in $100,000 and the equity multiple is 2x, you should get $200,000 at the end of that investment. So that 2x means your equity or your investment has been multiplied by 2. And therefore, the $100,000 becomes $200,000. But as you can see, if you get that $200,000 in 20 years, it's not worth the same to you. And that's why that IRR is also a consideration. You've got to look at all of these things together, the IRR and the equity multiple. You want to double your money, but you don't want to double it in 20 years. You want to double it in 5 years or so. So those are the main things you want to look at. You want to look at the cash on cash, the IRR, and the equity multiple. So you might be wondering, well, what kind of numbers should you be looking for? Well, most of the time, commercial real estate investors are looking for a 15% IRR and a 2x multiple. Of course, that doesn't always happen. That's going to be very different depending on the type of deal and the type of risk you're taking. So in our development deals, for instance, IRRs can be pretty high at like 20%. And then some multifamilies might be 12 to 15%. It's going to depend on the type of deal and the cap rate, and then all those factors that go into the cap rate, which is the risk and profitability of that investment. And the other thing you need to consider when you're investing is the hold period. The hold period is the length of time that that money will be held and invested for you. And a very important number to keep in mind, because that means you cannot access that money. That money is not liquid. You cannot trade it in. You would have to find another buyer for your shares, or the sponsor would have to buy you out. And both of those are pretty rare occurrences, so it's not likely that you can get out of the deal. Make sure you ask what is the hold period and what are the consequences, or what are the mechanisms for exiting the deal if you had to. If you think you might need that money at all, you should not put it in a syndication, because most syndications are long-term investments and usually about 5 to 7 years. So a lot of my investors, for instance, will use their self-directed IRAs or other money that they are not going to be using for any immediate needs. And the other thing to really keep in mind is that these are all projections. These are not fixed rate of returns. These are not guarantees. And when the sponsor is creating a pro forma, they are estimating what the end cap rate or exit cap rate will be, and therefore what this property will eventually sell at. They don't really know that. They have a guess based on the market and their research, and that sale price is going to determine your returns. So if the market's doing great, the cap rates are low, and your values are high, you're going to make a great return. But if it's the other way around, you might not hit those returns. So just keep that in mind, and don't be afraid to ask. If you are looking for more information on how to evaluate real estate syndications, check out my free ebook below. And don't be afraid to ask questions, because this is your money at the end of the day. And without your investment, the deal would not be possible. So just keep that in mind and recognize that it is an investment, and every investment has some degree of risk. And don't ever invest more than you are comfortable with. So those are the top 3 metrics: the cash on cash, the IRR, and the equity multiple. If you want to learn more about commercial real estate syndications and how to evaluate them, make sure you download my free ebook below, and also check out our website at thedoctorinvestor.com and follow for more content.